Hello, and welcome to our first pre-course lecture video, I guess you could say, dealing with Chapter 12. And in Chapter 12, we're going to look at some lessons that have been learned from the capital market history. So in this video, we're just going to look at specifically how to calculate the return, how to calculate the return on an investment. We're also going to discuss a little bit about the historical returns on the various types of investments that are out there. Now, we're going to be looking primarily at large cap or large company stocks, small company stocks, large company bonds, as well as large government bonds. Okay, so we're going to be looking at those types of returns for those various instruments, and we're going to talk about what happened in history, right? So we're going to look at historical returns, we're going to look at historical risk, and then finally we're going to finish up with the concept of market efficiency. What is that, and how exactly does that come into play? So the first thing we're going to look at, we're going to get into returns, and we're also going to look at the historical record. Okay, future videos, we'll talk about the average returns. We'll talk about the variability of returns, which incidentally are lessons 1 and 2 that we learned from the history of capital markets. We'll look at average return a little bit more, and then we'll talk about the capital market efficiency. So let's just jump right in and look at risk, return, and in financial markets. Okay, so what we're going to do is try and figure out, or we're going to calculate returns. So there's really 2 ways to look at the return an investment provides. We can either look at it in terms of dollars, or we can look at it in terms of percentages. So the first thing we're going to look at is dollar returns. Okay, what is a dollar return? How do we calculate it? Well, it's important first to recognize that when we're talking about dollar returns, it's actually made up of 2 components. First component is going to be the income component. That is the direct cash payment, things like dividends, interest. Those are the income component of a return. The second thing we need to look at when we're looking at the dollar return is the price change. Okay, what do we mean by price change? Well, we're either talking about a capital gain or capital loss, meaning we buy a stock or a bond at $10. Over time, the price of that bond or that stock is going to hopefully go up, but it also could go down. So when we're talking about capital gain or capital loss, we're talking about the change in price from when we bought it till now, okay, or some t in the future, some time in the future, okay. So how do we calculate total dollar return? Well, it's easy. The income component plus the price change. So let's look at an example. So let's say for a moment that you bought a bond for $950 a year ago. You have received 2 coupons of $30 each, so that means we received 2 $30 coupon interest payments. We can sell the bond for $975 today. We need to figure out what is your total return, or what is your total return in dollars. Now, notice it says you can sell the bond. It doesn't say you do. So my question is, if we decide not to sell the bond, does the way we calculate total dollar return change? And the answer is no. Meaning, we always include the income component, and we always include the capital gain or the capital loss component. Okay, the fact that we either sold or did not sell is inconsequential to that. We always have to include those 2 things. Now, you might be getting a little confused, okay? Whether you decide to sell or hold the security, the return's the same. The return is always going to be the same whether we buy or sell. But you might be saying, well, wait a minute here. There's, you know, you may think that if you don't sell a security, you won't have to consider the capital gain or the capital loss that's involved. Well, that's a mistake, right? And that's a common investor mistake, right? Holding a loser too long because you're reluctant to admit a bad debt or you're unwilling to admit a bad decision was made, right? We still have to incorporate that capital gain or that capital loss, okay? Non-recognition, right? That's relevant for tax purposes, okay? Realized income must be reported, okay? So what we're saying is whether or not you liquidate the asset, it's irrelevant, right? When we're measuring a security's pre-tax performance. So that's what we're doing here. We're looking at pre-tax performances, okay? So we need to annualize total returns so that we can compare the performance of different securities that are available within the market. So what is the total dollar return? Well, we already know income component plus change in price component, right? The income component is $60. Well, that makes sense. If we got 2 coupons at $30 each, that's $60. The capital gain portion, we take the price of today, which is $975, minus the price a year ago, or the price we paid for it a year ago, which was $950. That difference is $25. So the total dollar return for this investment is going to be $85. That's the $60 in income plus the $25 in capital gains. So again, we're looking at pre-tax issues here. If we sell it, there's a difference between realizing and recognizing, right? We're only going to realize the income for tax purposes. We're not going to realize the capital gain because we didn't sell it, right? But we still, for reporting purposes and being able to compare and contrast different investments, we still need to recognize that capital gain or that capital loss. Now, the second way we can calculate returns is on a percentage basis, okay? And a lot of times this is more intuitive than reporting gain or loss in dollars, okay? It makes a little bit more sense to look at it from a percentage standpoint than a total dollar standpoint. So how do we calculate percentage returns? Well, the percentage return is equal to the dollar return divided by the initial investment, okay? So we need to break apart some of the pieces here, okay? And what we need to look at is we need to look at the dividend yield and we need to look at the capital gains yield. Capital gains yield is very, very simple. Capital gains yield is nothing more than the difference in the price divided by the original price, okay? Dividend yield, quick review because we did look at this last semester. You take the dividend divided by the initial price, okay? So it would be very helpful if you knew how to calculate the dividend yield, the cap gains yield, and the total percentage return. Again, I'm not looking for you to be able to put numbers to it, just, hey, how do I calculate the dividend yield? Oh, I take the income divided by the beginning price. How do I calculate the capital gains yield? Well, that's easy. Ending price minus beginning price divided by the beginning price, okay? The total percentage return, we're just taking our dividend yield and adding our capital gains yield or capital loss yield. So let's look at a quick example. Say you bought a stock for $35. You received a dividend of $1.25. The stock is now selling for $40, okay? First, what's the total dollar return? Total dollar returns is nothing more than the income plus capital gain or capital loss, okay? We take $1.25, which is our income, plus the change in price, which is $5. Our total dollar return is $6.25. Hey, that sounds great, but that's not very intuitive, right? Let's look at it from a percentage standpoint. So what's the percentage return? Well, in order to do that, again, I need to first calculate my dividend yield. Then I need to calculate my capital gains yield. And then to figure out what the total percentage return is, I add those two together. So let's calculate the dividend yield. We take the income, or the dividend, which is $1.25, divided by the original price, which is $35. We have a dividend yield of we have a dividend yield of 3.57%. Now let's look at the capital gains yield. Very easy to do, right? Ending price minus my beginning price divided by my beginning price. 40 minus 35 is $5 divided by 35 gives me 14.29%. So the total percentage return is 3.57 plus 14.29 gives me my 17.86%. Okay, so what we're going to do now is we're going to look at financial markets, right? And we're going to look at them from an historical standpoint. But before we jump into that one, it's important to recognize here that why are financial markets so important, right? Well, again, it allows companies as well as governments and individuals to increase their utility, right? What's a utility, right? To increase my benefit, right? So think about it this way: regardless if you're a saver or a borrower, okay, we have the ability to either invest in financial assets, or if we're a borrower, we have access to capital, right, that's available, so we can either invest in productive assets if we're borrowers, or if we're savers, we can invest in companies who can then provide us with a return, okay? Now, why would you want to save instead of spend? Well, think about it. I can either have $100. I can either save it, or I could go out and buy something, right? Maybe I'll buy a new phone or a fountain tip pen or something, okay? In order for me to save it, I need to have some, that's what I'm looking for here, some initiative, right? It has to be worth my while to save it, as opposed to go out and buy that awesome new fountain tip pen I want, okay? So what happens is, by deferring our consumption, meaning by deferring the buying of the pen or the phone or whatever, instead I'm going to earn a return, and that return is going to compensate me, or you, whoever, it's going to compensate the saver for not spending that money and actually saving it, okay? What we have here is a list, if you will, of stocks, okay? So what this is we're looking at the nominal pre-tax rates of return for large cap stocks, small cap stocks, long-term government bonds. Yeah, those three. So we're looking at the investments in different types of portfolios, right? And the portfolios are either going to be, small, large, or long-term government bonds. And we can see by looking at this that actually the small company stocks did the best, right? And we could see that the long-term government bonds actually paid the lowest return, okay? So let's take a closer look at these numbers. Now, this slide means absolutely nothing to us, right? So we need to look at the book. And what they did was they took, if you'll notice, these are the year-to-year returns from 1926 to 2016 for large company stocks, long-term government bonds, and U.S. Treasury stocks. Okay, so as I scroll, you can see that it goes all the way down to 2016. Okay, so basically what we're saying here is, let me just scroll up here just to make it easier. Okay, so large cap stocks, they had a return, the average return in 1926 was 13.75%. Long-term government bonds were 5.69%, and the U.S. Treasury bill return was 3.3%. And we have that historical information from 1926 to 2016. Okay, so let's go back to the slides here for a minute. There we go. And basically, what we're looking at here is the average return. Okay, the average return for large stocks, small stocks, long-term corporate bonds, long-term government bonds, and UST bills, right? So how do we calculate that average return? Well, the average return is very easy. It's the arithmetic average, okay? So basically, all that we're doing is we're summing up all the observed returns from 1926 to 2016, and then we're dividing them by the number of observations, okay? So if we go back, 13.75% large company, 35.7, 45.08, up to 1929 we have negative return. We're adding up all these returns, okay? And we're dividing by the number of observations, and we see that we have about 12% is the average return. So that's how you calculate the arithmetic return, okay? When we come back in our next video, we're going to look at risk premiums. But again, the takeaway from this video is making sure you understand how to calculate total dollar returns, how to calculate percentage returns, okay? And we'll get into a lot of examples in class as well, okay? So tune back into our next video where we look at risk premiums.